Hey everyone, Target is beacon of affordable chic, where you could find everything from the latest fashion trends to everyday essentials, where you could buy groceries, a trendy lamp, and a new swimsuit all in one go. It was the go-to place for a one-stop shopping experience catering to all your needs under one roof. Well, buckle up because things have taken a turn. The once bustling aisles are now eerily quiet and the vibrant energy seems to have faded. Since early 2022, Target has been bleeding red ink, and not the stylish kind. The financial reports paint a grim picture, with losses mounting and the company's stock taking a significant hit. This isn't just a blip on the radar, we're talking about a full-blown financial nosedive. The numbers are alarming, and the downward trend shows no signs of slowing down. Sales are down, profits have plummeted, and investors are sweating more than a shopper trapped in the home decor aisle during a summer clearance sale. What went wrong? How did a retail giant like Target find itself in such a precarious position? The short answer: a perfect storm of economic headwinds, questionable business decisions, and a healthy dose of bad luck. The economic landscape has been challenging, with inflation and supply chain issues creating significant hurdles. But let's not get ahead of ourselves. To truly understand the depth of the situation, we need to examine the factors that led to this downfall. To understand how a retail giant like Target stumbled, we need to dig a little deeper. We'll explore the strategic missteps, the external pressures, and the internal challenges that have all contributed to this crisis. Stay with us as we unravel the story behind Target's red alert. One of the biggest blows to Target's bottom line has been the dramatic drop in consumer spending. Thanks to inflation soaring higher than a kite in a hurricane, people are watching their wallets more closely than ever. Suddenly, that cute throw pillow or impulse buy waffle maker doesn't seem so essential. Discretionary spending, the lifeblood of retailers like Target, has dried up faster than a puddle in Death Valley. And here's the kicker: Target, known for its trendy but affordable merchandise, found itself caught in a bind. Its core customer base, feeling the pinch of inflation, was less willing to shell out for non-essentials. As if a shrinking customer base wasn't enough, Target also made some strategic missteps that compounded its woes. Those mountains of unsold merchandise clogging up clearance sections. Turns out Target misjudged the post-pandemic shopping landscape. They bet big on categories like home goods and apparel, assuming the stay-at-home trend would continue. But consumers had other plans. They were ready to ditch sweatpants for real pants and spend their money on experiences, not stuff. This left Target with a massive inventory glut and a serious case of buyer's remorse. Faced with mounting losses, Target has been forced to make some tough decisions, including shuttering stores. Now, closing underperforming locations is standard retail practice, but Target's strategy has raised eyebrows. Instead of just trimming the fat in struggling markets, Target has also closed stores in major cities, citing declining foot traffic and, more controversially, organized retail theft. This has sparked accusations that Target is using crime as a scapegoat for deeper problems. Critics argue that blaming theft deflects from internal issues like poor inventory management and failing to adapt to changing consumer habits. The blame game: theft or tactics? Let's be clear, retail theft is a real problem, and Target has every right to protect its merchandise and employees. But the company's decision to publicly link store closures to theft has drawn scrutiny. Some argue that Target is exaggerating the impact of theft to mask its own missteps. Others point out that closing stores in major cities disproportionately affects low-income communities and communities of color. The optics of this situation haven't exactly been great for Target. It's one thing to acknowledge the challenges of retail theft, it's another to use it as a catch-all explanation for broader business struggles. The consumer strikes back. In recent times, the power dynamics between consumers and corporations have shifted dramatically. No longer are consumers passive recipients of marketing messages. They are active participants in shaping brand narratives. Adding fuel to the fire is the growing consumer backlash against Target's recent Pride Month collection. This backlash is not just a fleeting moment, but a significant indicator of the changing landscape of consumer behavior. The company faced boycotts and criticism for featuring LGBTQ+ themed merchandise, which sparked a nationwide debate. The controversy wasn't limited to social media. It spilled over into mainstream news, making headlines and drawing attention from all corners. With some accusing Target of pushing a woke agenda, the situation escalated quickly. Protests erupted and heated arguments broke out in stores, reflecting the deep divisions within society. While Target has defended its commitment to inclusivity, stating that it stands by its values and the diverse communities it serves, the backlash has been a stark reminder of the risks involved in taking a stand on social issues. The controversy further alienated a segment of its customer base, leading to noticeable declines in foot traffic and sales. The empty aisles and upset customers are a testament to the impact of consumer sentiment. This incident highlighted the challenges of navigating politically charged issues in today's divided climate. Companies are finding it increasingly difficult to please everyone, and any misstep can lead to significant backlash. The takeaway? Consumers are paying attention more than ever before. They are scrutinizing every move a company makes, and they are quick to voice their opinions both online and offline, and they're not afraid to vote with their wallets. If they disagree with a company's stance or actions, they will take their business elsewhere, making their dissatisfaction known through their purchasing choices. Whether it's perceived corporate missteps, political stances, or simply a desire for better value, consumers are more empowered than ever to make their voices heard. They are comparing prices, scrutinizing product labels, and making informed decisions about where to spend their money. This shift in consumer behavior is forcing companies to rethink their strategies. Shoppers are sending a clear message: adapt or become irrelevant. In this new era of consumer activism, companies must be more transparent, responsive, and aligned with the values of their customers if they hope to thrive. Navigating the shifting sands of retail. So where does Target go from here? The retail landscape is more competitive than ever, and the company can't afford to rest on its laurels. To regain its footing, Target needs to address its internal challenges head-on. This means getting its inventory in order, rethinking its pricing strategy, and adapting to the evolving needs and desires of its core customers. It also means acknowledging the missteps of the past and finding ways to rebuild trust with consumers who feel alienated or left behind. Can Target hit the bullseye again? The good news is that Target isn't down for the count just yet. The company still has a loyal customer base, a strong brand identity, and a vast network of stores. But to survive and thrive in the years to come, Target needs to embrace change, listen to its customers, and find a way to recapture the magic that made it a retail darling in the first place. The future of Target remains uncertain, but one thing is clear: the company that once seemed invincible is now facing a fight for its very survival. A future uncertain: lessons from the brink. The story of Target's decline is a cautionary tale for any business, big or small. It serves as a stark reminder that no company, regardless of its size or past success, is immune to the forces of change. The retail industry is particularly unforgiving, with its rapid shifts in consumer preferences and technological advancements. It's a reminder that even the most successful companies can stumble when they fail to adapt to changing market conditions, ignore consumer sentiment, or underestimate the power of digital transformation. The rise of e-commerce and the increasing reliance on online shopping have dramatically altered the retail landscape, or lose sight of their core values. Companies that once thrived on their brick-and-mortar presence now find themselves struggling to maintain relevance in a digital-first world. The importance of staying true to one's brand while also embracing innovation cannot be overstated. Whether Target can turn things around remains to be seen. The company faces numerous challenges, from revamping its supply chain to enhancing its online shopping experience. It must also reconnect with its customer base, understanding their evolving needs and preferences. But one thing is for sure: the retail landscape is littered with the remnants of companies that failed to heed the warning signs. From once dominant department stores to beloved local shops, the history of retail is filled with cautionary tales of businesses that couldn't keep up. Target's future hangs in the balance, and its journey will be closely watched by industry analysts and competitors alike. The company's ability to innovate and adapt will determine its fate in this ever-evolving market. a stark reminder that in the cutthroat world of retail, yesterday's success is no guarantee of tomorrow's survival. The lessons learned from Target's struggles are invaluable for any business looking to navigate the complexities of the modern marketplace. Adaptability, customer focus, and a willingness to embrace change are key to enduring success.